Okay, I get it. You've been watching my videos and now you're in a trade and it's in profit, and now you just need to figure out what's the best way to actually exit the trade. So I have good news for you, because I'm going to be going over every single thing you need to know in order to exit your trades properly. I'm going to be showing you all the different things that you need to consider. I'm going to show you the best possible ways to exit your winning trades properly. So if that's something that can help you out, what I would recommend is you actually get a sheet of paper and write this stuff down so you can actually leave it on your desk, so you can have a constant reminder whenever you're in a trade to look for these 7 things whenever you are actually exiting a trade. So if you like the sound of that, you already know what to do. Hit the little like button, comment down below, do all that YouTube algorithm bullshit while I roll the intro. Okay guys, so number 1, the very first thing that we need to consider is what type of trade are we actually in? And let me kind of explain what I mean. And for those of you that are doing scalping or scalp trading, I'm sorry, I cannot help you with this. But for everyone else, we need to kind of consider which 2 camps are we currently in for this specific trade. Are we doing like what's called like day trading or swing trading? Or are we on the other side doing what's called following the trend trading, or position trading? Depending on which type of these 2 styles that you're trading, you'll be looking at 2 various different parameters for your exits based on which style of trade that you're currently in. So sometimes you would want to be doing a day trade or even a swing trade, or other times you might just want to follow the complete trend and try to maximize the pips doing position trading. So based on whichever trade that you're currently in, you would need to consider various different factors on how to exit the trade. And I'll go into those factors here in a little bit in this video, but let's talk about number 2. The second thing that you need to consider whenever you're in a trade is you need to understand, is there any opposing fundamental analysis news that's going on in the economies that might allow the price to start reversing the other way? Is there something happening in any of those 2 countries that you're doing your trade in based on whatever currency that you're trading? Is something happening in the country, or is a specific news or a different event being released that could potentially allow the trade to go the other way? That's the second thing you need to consider. And matter of fact, towards the end of the video, I'll show you how to mitigate any effects that various different events might affect your trade in, how to kind of safeguard yourself so a negative news event that you're not in control of will allow you to kind of save that trade and not allow that trade to go against you. But the main thing is, with fundamental analysis, most traders don't pay attention to fundamental analysis. So they might be in a trade that's probably 30, 40 pips in profit, and they're excited about that trade, but they don't realize there's a specific news event coming out in the next 30, 40, 50 minutes, and they're still in that trade, and they're completely unaware of the news event. And what happens is, if that news event goes against their trade, that trade can instantly shoot down back to $0 profit, or even put you in a loss. So you want to be aware of what is going on in the world around you, in the fundamentals, or even the events that are occurring whenever you are actively in a trade. And how do you do this? You would just literally look up any economic calendar online and just kind of see, is there anything happening at that moment? Is there anything happening in the near future, in the next few hours, or however long that you want to be in that specific trade for? And if there's no specific planned events happening, then there's a very low probability that any fundamentals will affect your trade too much. So in that case, you are pretty much roughly in the clear. Just still, you should be paying attention to fundamentals in case something sporadic does happen in the news for any of those 2 countries for that currency pair itself. Now, the third thing that you need to consider whenever you're exiting a trade is, are there any technical factors, technical barriers, technical reasons where the price might allow you to have any opposing pressure going the other way? So let's say you're taking a long, let's say you're buying into a trade going in the up direction. You could ask yourself, are there any technical reasons? For example, is there a very strong resistance area happening in that specific area, which might cause the price to start going down? If there is, you would want to take profit right before that resistance area even occurs. I'll give you an example really quickly, in fact. So let's just say that you've entered a short on this little double top here, and you say, you know what, I'm going to enter a short here. So you need to think about, are there any technical reasons where the price might react? So you might even consider this little bottom here as a potential support area, right? So you would enter your trade. You would have your trade activated. Obviously, as I mentioned before, you would have your stop loss right above, and then your take profit. If you see that this is a technical area where there might be an opposing pressure to go long, meaning a lot of bulls might want to enter long positions somewhere in this area, you would want to take your profit just literally right before that actual area approaches itself. This way, you're not left with your hand held high, where if your take profit is way down here, you don't want the price to continue to bounce back up and it never hit your take profit. So you would want to have a conservative take profit above the actual zone itself. And just to give you an example, you'll see the price goes down, hits that support area. So you could technically take a long if you want over here as well, but that's not the point of this video. It's more about understanding where you would want to be able to take your profit, looking at any specific technical reasons that might allow you to take profit. So that's just one example on taking profit based on technical factors. Matter of fact, there are quite a bit of different technical reasons why you could want to take profit. Some other examples are, if a trend line gets broken, you would want to potentially look to take profit to avoid the market, the price starting to go the other way. Some other reasons are maybe even a moving average. If the price is approaching maybe a strong daily, maybe a 100 or 200 daily moving average, you might want to take your profit at that point. Or if you're one of the traders that use like a moving average cross, you might also consider that might also be a potential reversal of the trend. You might want to consider closing your trade if one of those different parameters occur in the market while your trade is actually running. So this technique, as I mentioned towards the beginning of the video, you want to consider which type of trading styles that you're actually doing, right? So looking at any technical factors, this is most useful for people who are doing either day trading or swing trading. So you would technically want to look at any technical factors while always remembering, always keeping in mind if there's any fundamental reasons or any news events that are happening that could also affect your trade. Now, going on to number 4, the fourth thing that you should consider is if you are doing either position trading or trend trading, you would want to look for an area to take profit using what's called a trailing stop. This is a very common way that a lot of people use trailing stops to essentially try to gain as many pips as they possibly can following a trend in a specific direction without having a very specific take profit set in place. Let me just kind of give you an example. So the currency pair that I'm looking at right now is just USD CHF. So let's just say, for example, that you saw this little area right here. This was let's say this was a huge resistance area. The price was having trouble piercing this area here, and the price eventually did end up piercing that area right over here. The price pierced that area, and now you were just patiently waiting for the price to actually come down for the retest. So let's just say you entered on the simple break and retest of this resistance slash support, right? So let's say you enter right over here. So now, a way, if you wanted to follow the trend, if you were a trend-based trader or a position trader, these position traders are a little bit long-term traders, same exact thing as like a trader who likes to trade following the trend. So a way you could employ the trailing stop is, what a lot of traders do is, you would use what's called the ATR. So let me just kind of pull it up really quickly. So you would just pull up the ATR, just search average true range, or just search ATR, and the indicator will show up. And you'll notice the currency pair that I'm currently on is USD CHF, and the indicator shows up at the bottom. So let me just kind of explain how you would use this to determine your trailing stop. So I want you to look at this little number right here, right over here, this little decimal place number. This shows you how many pips based on the vertical column that we're looking at. We're looking at this column. You see, as my mouse moves, these numbers are consistently changing. It's based on which candle that I'm currently on, right? So you would look at, whenever you enter your trade, let's say you enter the trade over here, you would look at what the ATR is at that point. So you see it says 0.00509. And if you guys remember, the very last decimal place, the 5th decimal place, that's called the pipette. So we would kind of ignore that. So you would understand that the ATR, the average true range, is 50 pips. Meaning from this point, literally from this day, the average range of the candles for the past X amount of days have been on average 50 pips that the pair has moved each day. So I mean, each day on average, this pair is moving 50 pips up or down. Either way, that's the average range that is moving. So a way to kind of set your trailing stop is, a common way to do it is just to do 1.5 times the ATR. Let me just give you an example. So if the ATR is 50 pips, you would just multiply that by 1.5 and you would put your trailing stop loss at 75 pips. So you would enter here and you would set a trailing stop at 75 pips. So let me kind of explain and illustrate exactly how this works. So first of all, let me just measure 75 pips. Right here, 75 pips. And let me just kind of make this less transparent. So you can see this whole block. This block is 75 pips worth of distance, right? So you would set your trailing stop. And how the trailing stops works is however far the price goes up, at the highest point, at the tip top point is how far your stop loss will automatically follow that area. So let's say right here is how high the market went. So the trailing stop will automatically, let me just kind of change the color of this really quickly for you. Red, and let's make it thick. So the trailing stop would automatically be right over here if the market does end up going back down to this point, then your trade will automatically be closed, right? So this is why you kind of want to have the trailing stop a little bit bigger than the ATR, which 1.5 is a decent amount, right? But obviously, since the price didn't reach it, this trade was never closed. So what will happen is, as far as the price is continuing to move up, this trailing stop will continue to follow it and will continue to allow your stop loss to stay up there. And you'll notice the price still hasn't hit the stop loss yet, right? And if you continue to go up, if we continue to follow it, let me just make it a little bit taller. If we continue to follow it, you'll notice this was the next tip top place. So the trailing stop would follow that. And did it reach your stop loss? Did the price end up reaching the stop loss? No, right? So you're still in the trade here, right? So you've saved your trade at this little retracement. You've saved your trade at this little retracement. You've also saved your trade at this little retracement. And now the trailing stop will continue to follow the price as it's moving up to the very tip top point, which is this red candle over here, this little red little wick right over here. It'll continue to follow it until that little spot over there, which will allow your stop loss to continue to go trailing it by 75 pips. And if the market does end up going down by 75 pips from the highest peak, then your trade will automatically get closed. So instead of looking at a specific barrier or any technical reason to close your trade, you're just allowing yourself to follow the trend indefinitely until the market does end up retracing 1.5 times the actual ATR. So to give you an example, by employing this strategy on a position trade, you would have netted, had your entry been here, you would have netted 400 pips just off of using the trailing stop. So this right here, using a 1 standard lot size, that's a $4,000 trade. If you were doing a 2 standard lot size, that's an $8,000 trade. And in how many days? That's 20 days. That's literally riding this trade out for 3 weeks of your life, just being patient with it, allowing the trailing stop to do its thing. And you've netted $4,000 or $8,000, depending on however big your trade size is, just allowing the market to do its thing. And obviously the same thing can happen on the way down. You notice the same exact thing is occurring. It's swinging down. So if you made a short here, you could just let that bad boy ride all the way until the market does end up retracing 1.5 times the ATR. You'll notice the ATR now has changed. Look at it. It says 645, right? You would ignore the 5. You just look at 64, right? So same exact thing, 64 times 1.5. So your trailing stop would be 96 pips in this example. I just gave you 2 separate examples on how to understand what to make your trailing stop. Now that one was a little bit long, but I really needed to explain it the correct way so you fully understand how to use a trailing stop. So number 5, you need to ask yourself, Are you exiting according to your trading plan? Are you following the rules that you should have already predetermined prior to even getting into the trade? Are you following those rules whenever you're looking to exit your trade? And you need to be true to yourself. You need to be truthful with yourself, and you need to genuinely ask your question. Is this following all the rules that I've set for myself to exit my specific trades. Because if it's not following your rules, you know it, you'll know it from your heart that you probably shouldn't be exiting the trade there. Most people end up, if they do end up exiting their trade, not following their plan, they usually end up exiting way too early. And then they look at the market a few hours later and they think to themselves, damn it, like I should have stayed in the trade. I shouldn't have exited because my rules weren't really telling me to exit the trade. Because if they see like a small little retracement happening in the market, they might get scared and exit the trade. If they see like one red candle occurring in the market when they were in 75 pips profit or 80 pips profit, and now they're back to like 60 pips profit. So they might end up kind of being scared and say, you know what, I'm just gonna cut my trade here. I'm just gonna close it here. And then the trade obviously continues to go in their favor and they kind of like kick themselves in the foot, right? So that's number 5, making sure that you're actually following the trading plan that you have set. Which actually leads me to number 6. Are you exiting based on emotions, or are you exiting based on what you're looking at in the actual chart or any fundamental things that are actually happening? In fact, before you even enter a trade, and listen to this carefully, before you enter your trade, you should have already determined where you want to take your take profit before you even enter the trade. Because this way, if you have your parameters set, you won't have to interfere with the trade at all because you've already had your take profit predetermined before any emotions even set in. However, if you find yourself looking at the charts consistently while you're in the trade, micromanaging the markets, and the market does not like to be micromanaged. In fact, hell, no one likes to be micromanaged. If you do end up micromanaging your trades or the chart doesn't like that, and the chart's going to take some damn money from you. That trade is not going to go as well as you actually planned it. So one thing you should really truly consider is if you end up always like looking at your chart constantly and you're consistently looking at it, that means you are not confident with your trading plan and you are not confident with that very specific trade. So number 1, you either need to go back to demo and need to like retest your strategy even more, or number 2, you need to ask yourself, was this even a very clean trade to even enter? Because if this wasn't a clean trade, you should have never entered it in the first place. So every single time that you enter a trade, you need to have confidence in that trade no matter what. And you need to be okay with whether the trade goes against you or in your favor. You need to literally be dialed in to yourself and not care about the outcome and don't even expect any outcome to occur. Just be okay and happy with it. However, we're talking about in this video, a trade that's in your profit. So you shouldn't even have those emotions since this trade is in your profit anyways. So make sure you have your take profit already predetermined to avoid you having to even stare at the charts and even make any emotional decisions in the first place. Don't be that trader. Don't be that guy. Don't be that newbie that makes all these emotional decisions, because you have to think to yourself, are these institutions, are these big funds making these emotional decisions? No. So you need to ask yourself, are you going to continue to have the mindset of a retail trader, or are you going to fix your mindset and turn your mindset into an institutional trader? And number 7, this is super, super, super important. Most people never even think about this, but it's very easy to do. And this will allow you to make a lot more profits than you probably would have previously. You guys need to remember, for number 7, you guys need to remember that you don't have to close 100% of your trade at take profit. You don't have to close your whole position. You can close out half of your position. You can close out a quarter of your position. You can close out 75% of your position. It doesn't matter. You can close partial positions and then you can let the rest run to maybe like a second take profit, or maybe you can take profit on the first position and then let the rest run with a trailing stop just to try to get as many pips that you can possibly can, right? And a very easy way to kind of look at using a potential partial take profit is, I'll just use this example here. Let's say you went long over here, and let's say you see this little obvious little barrier right over here. I'll go to the 4-hour time frame. Let's see, you see this obvious little barrier here. So as you entered your trade here, you could have let me just erase all this little stuff here. You could have your partial take profit right here, right before it hits this little resistance area. And then once that's hit, you can have the rest of the trade running with a trailing stop. So this way you at least secure some profits guaranteed. and then you just let the rest continue to run without you having to even interfere with it. This will alleviate a lot of the stress for a lot of traders, and it'll just allow you to eat that extra icing on the cake, because let's face it, who doesn't like icing, right? So those are the 7 things that you need to consider whenever you're looking to exit your trade. So I hope you guys were taking notes, because you really truly should have this as a hard copy somewhere on your desk, or even in like your little notes app on your phone, because whenever you're in a trade, you need to make sure that you're following these 7 different things, so you are actually following a specific trading plan, and so you're not just randomly exiting off the spur of the moment. And make sure you're not exiting a trade just because you're bored of that trade and you just can't be patient enough to let that trade continue to run and allow it to do its thing and hit your actual take profit that you should have already predetermined before you even enter that trade. And I want to see who's actually made it to this part of the video. So if you have made it this far in the video, I want you to go down to the comment section below, and I want you to comment down what type of trades you mostly do. Are you mostly a scalper? Are you mostly a day trader? Are you mostly a swing trader? Or are you mostly a position or trend trader? Which type of trader are you? Go ahead and go to the comment section below, write it down so I can just kind of see what type of traders you guys are. And if you did enjoy this video, definitely leave a like, subscribe if you haven't subscribed to the channel already, and make sure you hit the notification bell so this way you can actually be notified whenever I do upload videos in the future. That is all, guys. Take care, and I'll see you guys in the next video. Go ahead and hit the like button, subscribe, do all that YouTube algorithm bullshit while I roll the intro.